This presentation discusses the two key types of bond risks, interest rate risk and reinvestment rate risk. I'm Pat Obi, professor at Purdue University, Northwest. Now, the more serious of the two risks is interest rate risk, which is a risk that as interest rates go up, bond prices go down. As interest rates go down, bond prices are going to go up. The risk, of course, is this guy right here. If you hold a bond and interest rates go up, you're going to lose value. Now though, but be careful to note that this risk is actually with respect to the price of an existing bond, because new bonds typically sell at face value. And if the face value is $1,000, that's how much you're going to pay to buy a new bond. And in return, the company is going to pay you whatever the market interest rate is at the time that the bond is sold. And that rate is going to stay fixed throughout the maturity of the bond. Anyhow, I note here that long-term bonds are more sensitive to interest rate risks than short-term bonds. Also, I note here that zero coupon bonds, which are bonds that pay you no coupons throughout their life, are even more so sensitive to interest rate risk, as I'm going to explain using this example. So I'm going to switch to spreadsheet real quick so you can see exactly what I did, and then I'll come back to that. So here's a spreadsheet. There are three types of bonds here that are used as an example: a long-term bond, short-term bond, and a zero coupon bond. Now, the face value of all the bonds is $1,000, as you see here. The long-term bond pays coupon of 8%, and I'm just going to assume a flat yield curve, and so this short-term bond also pays coupon of 8%. This is a zero coupon bond, of course, and pays no coupon. So semi-annually speaking, bonds typically pay interest semi-annually. That means the 8% coupon rate translates to $40 every half a year. So 8% of 1,000 is $80 per year, or $40 semi-annually. And so that's what it is across the board for these two coupon paying bonds. Let's assume right now though that the yield to maturity is 7%. And actually, I misspoke right here. We just assume that these two bonds pay the same coupon rate. All right, so here, suppose yield to maturity is 7%. And for simplicity, I'm going to assume the same 7% for the short-term bond. So that's where you find the flat yield curve. All right, now, and it's not going to matter the level of interest rates you use in the example. So now, this long-term bond is a 10-year bond, semi-annually, 20 periods. And the short-term bond is a 3-year bond, semi-annually, 6 periods. Using the PV function on Excel, I calculate the price of this long-term bond to be $1,071.06. And you can see the function right up there. And if I hit F2, you see it even better right here, what I did, right? The references. All right, in the same way, I calculate the price of the short-term bond. So now we assume that interest rates go up by 50 basis points, which is 0.5%, as you see there. So now the annual rate of return goes up to 7.5%, and this is the semi-annual yield to maturity. And as you can see, the price of this bond goes down to 1,034.74, a drop of 3.39%. The short-term bond also drops from 1,026.64 to 1,013.21, but this is only a drop of 1.31%, and that's where I calculated the percentage change in the value of these two bonds. So as you can see, for the same basis points change in interest rates, although drop in interest rates specifically here, although both long-term and short-term bonds experience a drop in their values, but observe that the percentage drop in the value of the short-term bond of the long-term bond is much more than that of the short-term bond. Even more interesting is the fact that for the same percentage change in the yield to maturity, from 7% to 7.5%, the zero coupon bond drops from $502.57 to $478.89, a drop of a whopping 4.71%. So as you can see, the longer the maturity of a bond, other factors equal, the greater would be the adverse impact that an increase in interest rates would have on the value of the bond. And for the same maturity, you find that a zero coupon bond, a bond that pays no coupon, would experience a much heavier decline in its value on account of the same increase in interest rates. So now, going back to the presentation, all of that is summarized in this lovely spreadsheet that I imported into your PowerPoint presentation. Now though, as it turns out, we can also use duration as a measure of interest rate risk. And earlier in a different lecture, you learned that duration, actually mathematically speaking, is the weighted average time it takes to receive all interest payments and in addition to the principal from a bond investment. Now, as it turns out, the longer the duration of a bond, the greater is the impact of a given interest rate change on the value of that bond. Now, first off, to explain how to calculate duration once again, suppose we look at that 3-year bond. So these are the financial facts of that bond. And we calculated the price of that bond to be 1026.64, which if I go back, that's what you see right here. Going forward again, to calculate the duration, this is the formula that you learned. And duration is typically calculated with annual data. So plugging in the annual coupon rates and everything, however, you got to put in the correct price here. We find the duration of this bond to be 2.785 years. Duration is measured in years. So now, using this approximation, we find that the percentage change in the price of this bond, given its duration of 2.785, is going to come out to be about 1.3%. Now notice, delta R is the change in interest rates. So if we expect interest rates to change, in this case to go up by 50 basis points or 0.5% in decimal form, that's what it is. Divide that by 1 plus the current level of interest rates, which is 7%. If I go back here, you see that to be the case, 7%. Going forward again, so that's how we get this. Now this sign in front of D is actually an indication of the fact that the change in the value of the bond is going to be negative to the change in interest rates. So it's not a mathematical sign in the sense of the results that you obtain here. It's simply telling you that the value of the bond will move in the contrary direction, in the negative direction to the change in interest rates. If interest rates go up, as in this case, bond price is going to go down. And in this case, as you can see, by about 1.3%, which if I go back here, that's exactly pretty much the change in the value of this bond from 1026.64 to 1013.21. So as I note here, is an investment idea that should probably hit you a little bit. And the question I pose here is, should I invest in a bond mutual fund or invest directly in bonds? As you know, a bond mutual fund is a portfolio of bonds. These mutual funds do not have maturities. So the bond portfolio manager is going to keep churning the portfolio, rebalancing it continuously. On the other hand, if you buy a bond based on the maturity that you desire, the bond is going to mature and then you get your principal back. So now, here's the danger about purchasing a bond mutual fund. If I go back to the spreadsheet right here, consider this 10-year bond. All right. Suppose that your investment horizon is 10 years and you choose to buy this bond. Now, even if interest rates were to increase over the time of this bond, we know that the value of this bond is going to go down. But if your holding period matches the maturity of the bond, then it really shouldn't matter too much to you, because just hold this bond until maturity, and the $1,000 face value you paid at the outset of this bond, you're going to get it back when the bond matures. And so nothing happens. But if you were to purchase a bond, if you were to buy into a bond mutual fund, 10 years from now, the bond mutual fund continues to go on. And if interest rates have gone up over the time that you are invested in the bond mutual fund, chances are that the value of the mutual fund at the time that you are withdrawing your investments would be less than it was when you bought into it. So, as in this case, let's say that 7 years later, this bond now has 3 more years to go. So, if I change this to 3, the maturity to 3, as you can see, the value of this bond drops to 1013.21, which is identical to this one here. But observe that 7 years from now, when this bond has 3 more years to go, the value of this bond would have declined by 5.4%. And of course, if as you can see, at any time that you liquidate this bond, if interest rates have gone down below what it was, have increased rather, above what it was when you purchased it, the value of the bond will go down for sure. So finally, if you purchase this bond brand new, and you might have purchased it a couple of years back, you paid $1,000 and the bond pays 8% per year, and it's going to pay you that 8% per year until maturity. So let's say that subsequently interest rates went up, and I'm just going to assume that interest rates have gone up to, let's say, 10%, and this bond now has 3 more years to go. So if you were to sell your bond right now, you're going to be selling it for about $949.24, which, as you can see, is almost 11.4% less than you paid when you purchased the bond brand new. So be very careful. If you wish to invest in bonds, I recommend that you invest directly in bonds. Buy bonds that correspond to your holding period. That way you know for sure, regardless of what happens to interest rate levels, you're going to get your face value back. If you invest in bond mutual fund, you may not quite be as lucky if interest rates have gone up over the horizon. Finally, reinvestment rate risk, which is a risk of a decline in interest income, right? The focus here is interest income as a result of falling interest rates. And I write here that short-term bonds are more exposed to this kind of risk. The reason being that short-term bonds are going to mature in short order. And if you choose to reinvest these bonds as interest rates interest rates go down, then the coupon interest income that you're going to be drawing from that bond would be lower than it was previously. If it is a longer term bond, whatever interest coupon that was promised you at the time the bond was sold will continue to be earned. And so as interest rates decline, short-term bonds, which would have to be reinvested in short order, would be more adversely exposed to this risk. When interest rates go down, the new coupons that you're going to be receiving as you reinvest into other short-term bonds will be less than it was initially. But as well, though, even if you buy coupon paying bonds and the bonds are long term, if you reinvest your coupons, the coupons that you receive from your long term bonds, those coupons are going to be reinvested also at lower interest rates. So understand the nature of the income effect of reinvestment rate risk separately from the nature, if I go back here, of interest rate risk, which hits longer term bonds more so than shorter term bonds.